Have you ever come across a situation where two companies swap assets, like trucks, land, or even services, without cash being the main part of the deal? How do we measure these transactions? Do we use fair value, or do we stick with carrying value? Well, today we're diving into non-monetary transactions under ASPE 3831 and IFRS. By the end of this video, you'll be able to clearly explain the rules, spot the key differences between IFRS and ASPE, and apply them with confidence on exams and in real-life cases. And before we jump in, don't forget to like this video and subscribe to Canada Accounting Insights for more CPA exam-focused accounting lessons. Let's start with the big question. What are non-monetary transactions? A non-monetary transaction, or NMT, is an exchange where the items traded are not cash or rights to receive cash, so inventory, PPE, intangibles, or even services can be exchanged. For example, suppose Company A trades an industrial warehouse for Company B's office building. No cash is exchanged. That's a non-monetary transaction. NMTS can be reciprocal, where assets are exchanged. Non-reciprocal, where one party simply transfers assets, like in-kind dividends, donations, or liquidation distributions to owners. Now that we know what they are, let's see how ASPE says we should measure them. Under ASPE 3831, the general rule is this. You measure a non-monetary transaction at the fair value of the asset given up or the fair value of the asset received, whichever is more reliably measurable. If both are reliable, ASPE says, use the fair value of the asset given up. That means remove the old asset at its carrying amount, record the new asset at fair value, recognize any gain or loss. For example, if Larry Lated trades an asset with Lulu Corp., Laris's asset had cost, $2.1 million. Accumulated depreciation, $1.05 million. Fair value, $1.35 million. Lulus's asset had cost, $2.025 million. Accumulated depreciation, $975,000. Fair value, $1.2 million. Since fair values are reliable, each company records at the fair value of the asset given up. Larry's journal entry would be debit asset, new, $1,350,000. Debit accumulated depreciation, old, $1,050,000. Credit asset, old, $2,100,000. Credit gain on exchange, $300,000, and Lulu would do the same for its numbers. But here's where it gets tricky. ASPE doesn't always let you use fair value. So next, let's talk about the exceptions. But here's the catch. ASPE prohibits fair value in certain situations. Let's go through them. Transaction lacks commercial substance, meaning the future cash flows aren't expected to change significantly. Think of swapping one delivery truck for another almost identical delivery truck. No real change in risk, amount, or timing of cash flows. Exchange of inventory or products in the same line of business, like two car dealerships swapping cars of different colors. Still inventory, still cars, same business. Fair value not reliably measurable. Maybe no active market data or valuations are too uncertain. Non-reciprocal transfers to owners, like spin-offs, liquidations. In these cases, we fall back on the carrying value approach. Record the new asset at the carrying amount of the old asset, adjusted for any cash in the deal. And speaking of cash, what happens if there's both cash and non-cash items in the transaction? Let's look at partial monetary consideration. Now, what if the deal involves cash plus a non-monetary asset? If fair value applies, the cash is just part of the calculation. But if carrying value applies, the party paying cash records the new asset at carrying amount of the old asset plus cash paid. The party receiving cash records the new asset at carrying amount of the old asset, cash received. If cash exceeds carrying value, a gain is recognized. Example, Josh Inc. trades an excavator. Net book value $150,000, future value $135,000 for a sailboat. Future value $135,000. $95,000 plus $60,000 cash. Since commercial substance exists, record at fair value of asset given up. Josh recognizes a $15,000 loss And this leads us right into the concept of commercial substance, which is absolutely critical. This is a huge exam trigger. Commercial substance exists if the risk, amount, or timing, RAT, of cash flows changes significantly, or if the entity-specific value of the asset received differs significantly from the asset given up. If commercial substance exists, measure at fair value. If it does not measure at carrying value, for example, exchanging trucks of similar size for the same delivery purpose, likely no commercial substance. Exchanging land that generates long-term rental income for inventory to be sold next year, clear change in timing of cash flows. Commercial substance exists. Now, this sounds very similar under IFRS, but there's a key difference in approach. Let's compare. Here's where students get tripped up. Under IFRS, there is no single standard for non-monetary transactions. Instead, the rules are embedded in other standards like IAS 16 PPE, IAS 38 Intangibles, IFRS 15 Revenue. But the principles are quite similar. Under IFRS, record at fair value unless the transaction lacks commercial substance or neither asset's fair value is reliably measurable. The main difference, ASPE prefers the fair value of the asset given up. IFRS prefers the fair value of the asset received, especially in revenue transactions. For example, if Vivi Windows exchanges windows for printing services, under IFRS 15, revenue is measured at the fair value of the services received, $25,000, not the windows given up. To make this even clearer, let's walk through an IFRS example involving assets with commercial substance. Copa Inc. trades an old excavator, NBV $150,000, FV $160,000, plus $300,000 cash for a new excavator. Future value $465,000. Because the new excavator has greater capacity and useful life, the transaction has commercial substance. Copa measures the exchange at fair value of what was given up. Old excavator FV $160,000 plus cash $300,000 equals $460,000. And just like under ASPE, presentation and disclosure are critical. So let's finish with that. Both frameworks also require clear disclosure. Entities must disclose the nature of the transaction, the basis of measurement, the amounts recognized, any related gains or losses. And under IFRS, the disclosure requirements depend on the standard that governs the asset. IAS 16, IAS 38, IFRS 15, and so on. So now let's wrap everything up with a quick summary. NMTS equals exchange of non-cash items. ASPE, use FV of asset given up, unless exceptions. IFRS, use FV of asset received, especially in revenue cases. Exceptions: no commercial substance, similar inventory, unreliable fair value, non-reciprocal transfers to owners. Always check for commercial substance using RAT, risk, amount, timing. And don't forget the journal entries, because that's where exam points are often earned. All right, let's close this out. So there you have it, non-monetary transactions under ASPE and IFRS, with key differences, examples, and journal entries. If this helped you understand the topic better, please hit the like button, subscribe to the channel, and share this with a fellow CPA students. Thanks for watching, and I'll see you in the next video.